You know, we're surrounded by them every single day. Offices, stores, apartment buildings. We use them, we live in them. But have you ever stopped to think of them as an investment? Well, that's exactly what we're going to do today. We're breaking down the entire world of commercial real estate, and by the end, you'll understand the buildings that literally shape our cities in a whole new way.
So let me just start by asking this. What if the very fabric of your city, all the places you go every single day, actually represented an entire universe of investment opportunities? Because, well, they do.
Let's start with the place so many of us call home. You see that apartment building on the corner? To an investor, that's not just a bunch of homes. Nope, it's a financial asset, and it's a huge cornerstone of what they call the multifamily sector.
Or how about the grocery store you pop into every week? That is a perfect example of retail real estate, a category that's been totally turned on its head by the way we all shop online now.
And you have definitely seen those massive new warehouses going up along the highway, right? That's not just random construction. It is a direct result of the e-commerce boom, and it's part of a red-hot sector called industrial real estate. You see, they're all pieces of the same giant puzzle.
So to make sense of all of this, investors basically group these properties into different categories. The easiest way to think about it is like a menu with 5 main courses. So let's go through the big 5 one by one.
Okay, first up, office buildings. Now these get graded by quality. You've got your shiny, brand new Class A towers, all the way down to the older, more functional Class C spaces. And the big trend right now, it's something called a flight to quality. With remote work sticking around, companies are basically fighting over the newest, coolest buildings with the best amenities to try and lure their employees back to the office.
Next on the menu is industrial. This is the literal, physical backbone of our digital economy. I mean, every single time you click Buy Now, you are putting this entire sector to work. And for these properties, there is one thing that matters more than anything: location. Being close to ports, highways, and big cities is what separates a good investment from a truly great one. And this is just fascinating. It shows how the exact same economic force can create completely opposite results. Let's take our third asset class, retail. For retail, e-commerce was a massive disruption. It forced malls to either die or totally reinvent themselves with things like restaurants and movie theaters. But for industrial, that same force was pure rocket fuel. It created this unbelievable demand for more and more warehouses, a true tale of two sectors. Okay, our fourth category is multifamily, which is really just a fancy way of saying apartment buildings. This one is a huge favorite for big investors, and for a really good reason. People always need a place to live, right? That makes it incredibly resilient, especially when the economy gets rocky. Plus, those short 12-month leases mean that landlords can adjust rents pretty quickly to keep up with inflation, which is a really powerful advantage. And finally, our fifth major asset, hospitality. We're talking hotels. Their income can literally change from one night to the next, and it's all measured by this key metric called RevPAR. That's revenue per available room. This lack of long-term leases makes hotels the most volatile category of them all. When the economy is great, they are unbelievably profitable. But when travel slows down, they feel the pain immediately. It is the absolute definition of high risk, high reward.
But wait, the world of real estate doesn't just stop with those 5. As our economy and our society change, all these new, specialized types of properties are becoming major investment classes all on their own.
And these niche sectors are being pushed forward by some seriously powerful trends. Self-storage thrives because we're always moving or downsizing. Data centers, they are the physical buildings that house the cloud. And with an aging population and all these medical breakthroughs, the demand for specialized lab spaces and healthcare facilities is just exploding. Okay, so now we know what the different types of properties are. But how do investors actually figure out if a building is a good deal or not? Well, they have a very specific scorecard they use to, do the math. And it all starts with this one number, net operating income, or NOI for short. Just think of it as the pure raw profit that a building generates from its day-to-day operations. It's all the rent you collect minus all the operating expenses like maintenance and insurance. It's the bottom line before you even think about the mortgage. And investors use that NOI to calculate the single most important metric in all of commercial real estate, the capitalization rate, or cap rate. Now, it sounds complicated, I know, but it's just a simple 3-step formula. You take that annual profit, the NOI, and you just divide it by the price you paid for the building. That's it. Let's look at a super simple example. Say your building makes $50,000 a year in pure profit, and you bought it for $1 million. Well,
you've got yourself a 5% cap rate. This one number gives you a way to compare the potential return of any property, anywhere, on a totally apples-to-apples basis. It's an incredibly powerful tool.
Now, of course, not all investors are looking for the same thing. It's a lot like the stock market, really. You can choose your strategy based on how much risk you're willing to take on for a certain potential reward. A core investment is the safest play. Think buying a brand new, fully leased office building in a major city. On the complete opposite end, you have opportunistic, which is the riskiest. That's like building a hotel from the ground up. And as you move up that risk spectrum from core to core plus to value add and opportunistic, your target returns have to get higher to make it worth your while for taking that extra chance.
So we've covered the asset types, the math, the strategies, but look, if you walk away remembering only one thing from this entire explainer, it should absolutely be the timeless golden rule of all real estate investing.
You've heard it a million times, I know, but it's a cliché for a very, very good reason. It is the single most important factor that determines the long-term value of a property, way more important than the building itself. But why?
A good location is just a place with strong fundamentals. It's where jobs are being created, where the population is actually growing, it's got great infrastructure so it's easy to get around, and crucially, it's a place where the demand for space is higher than the supply of new buildings being built. Remember, you can always fix a building, but you can never, ever fix a bad location.
So the next time you're driving down the highway or just walking through your own neighborhood, you're not just going to see buildings anymore. You're going to see assets, you're going to see strategies, and you're going to see the physical results of massive economic trends playing out right in front of you. You now see the building blocks of our cities. So the only question left is, which one would you bet on?